The market just keeps printing money for us. Who knew being lazy and trading could be so profitable? Here we are for doing pretty much nothing, sitting at another $1.90 for profit. That's right, $1.90. Now we can of course just take it off the table right now and have a nice little profit, or we could take and use a trailing stop loss and see if it might go up more throughout this session or maybe by tomorrow. I'm going to go with the trailing stop loss at $1.50 just because that has worked so well previously. It has been a very profitable little nuance, and it has just done exceptional, something that I really like. So let's get that set up. Hello, I'm Robert, and welcome back. Now let's get right to the live chart and get that trailing stop loss done. We simply click on our entry, and then on the TS at the bottom, and we draw where we want our trailing stop to be. So I want it at roughly $1.50. Of course, the program is not going to be easy or cooperative, but that's fine. We don't need it to be perfect. There we are. We've got it set. Let's submit it, modify the order, and now we have our trailing stop. So if the price goes up to the orange line, we cash out with a nice little 15% profit. We can live with that. Considering you only have the position of $10, a 15% profit is quite generous, when realistically I'm only looking for roughly 20 pips or a profit of 0.2%. I can live with this. This is nice, this is easy, it's comfortable. And if the market does continue tomorrow, later this session, to drop down beyond where it's at, then we have a rationality of being able to simply take a nice little generous profit above what we have. In fact, we can already see that the price has fluctuated and climbed to $1.98. And of course, the orange line has moved to help bring that in even better. But this brings us to another situation. As we see, the chart clearly indicates another line where buyers and sellers have found a contentious point where price doesn't necessarily want to go above. Now we already have one entry order in the waiting. It's just sitting out there waiting to be triggered at 443 units. We could move this order, or we could put another entry order at this position here, capitalizing on this particular boundary. Either way is fine based upon your risk assessment. It really depends on what you're hoping to gain out of the market in the relationship of what your risks are. For the purposes of this demo account and demonstration, I'm not going to move the existing entry order, but I'm going to create a new one, just to get the representation and effect of what it means to actually begin to layer multiple positions in such a way that we have a clear and present functional strategy. So we're going to continue in the short direction. I'm going to click on sell, and then I'm going to do 444 units. It's important to remember the first in, first out regulations apply. So you cannot have unit sizes that are equal, particularly if you want to use a trailing stop or a take profit on an individual position. So now let's take and drag this position where we actually want it. For the purposes of this example, I'm going to place it right here because I want to capture right where that candle touches the boundary that I want. That particular price that seems to be a good region. It is a reflective point that the buyers and sellers have apparently agreed upon. So now I'm going to submit my new entry order. And it's done. We now have two entry orders, one actual order in profit and one order in waiting. But this really is how we begin to layer our strategy in such a way that we can see the culmination of something larger. For example, since I am using roughly 1% of my account, what we are looking at here, if all four orders trigger, is a 4% reference. So right now, for the purposes of risk management, I have 4% of my account allocated. I'm going to allow myself up to 10% maximum, or a representation of roughly 10 positions. Risk management is everything. It is critical to understand, and it really is the basis of why this technique works so well. It's a fundamental framework of how you can make a profit in the market without stress, without anxiety, and without the worries of blowing up your account. I'm not going to say that it's not going to take losses, because you will take losses, as I have demonstrated previously in this series. But the goal is to take more profit than losses, with your primary emphasis always being on keeping your original balance as much as possible. So we have what we see is a clear sign that the market has been exhausted from the previous uptrend and that now the sellers are wanting lower prices. How far down will they go? Well, nobody knows. Realistically, anybody that tells you they know where the market is going is fabricating the truth. Because truthfully, nobody knows. Let's zoom out and look at the market. We can see clearly where our positions are, or where the market was, where it might go, so forth. We have a range of expectation, a reasonable place by which buyers and sellers might continue to agree on prices. Will they continue is a whole different question. It's never a good idea to try to guess where the market is going. Don't try to guess. Simply accept where the market is going and try to think about how that implication shows up in the market. For example, in looking at the longer range, we can clearly see at the level on the screen where I've placed the 444 unit entry order, that we have an area where the sellers have seemingly built a boundary or a zone of resistance. While the 443 unit entry order is above that, the representation of the last couple of weeks have a clear understanding that price is likely to not want to go above that point just yet. At some point it might, but right now, particularly with the last 2 days of the market showing a clear downward push, we can clearly see that as of right this minute, the sellers don't want to go above that price. That is a rational, reasonable approach to trading. By looking at the market with such a simple dynamic, you can make an informed decision of where you place your trades in a realistic and viable manner. Now, if you go back and you examine the market in a wider range, we can see that we have this huge uptrend around January, February of this year. Conversely, because this market is notably cyclical, meaning for every uptrend it has some level of an equal downtrend, and vice versa. At some point, as we see with the average and the median representations on the chart, that the price is likely to return to that level. It is likely to complete the cycle before beginning a new one. The Forex markets in particular are very cyclical in nature. If we go back even further, we can see, let me zoom out, we can see just how cyclical this market is and how it tends to quite often travel in sideways boundaries over time before these incredible upshifts or downshifts take place. These opportunities are critical when you look at the kind of trading style represented here, the lazy trading style. This is how you can gain a good level of profitability in the market just by watching simple patterns, by understanding the desire between buyers and sellers to find a fair price. Buyers won't buy if the price is too high, and sellers won't sell if the price is too low. That's what creates these kind of ranges, where it becomes indicative of just how the market works itself. The implications of this kind of range trading is significant because overall the market is in some kind of a range 70% of the time. 70% of the time, the market is ranging. It is flat. It goes from a consistent low point to a consistent high point and back and forth until some market dynamic forcefully changes that pattern. But realistically, those market dynamics don't happen very often. In fact, only 15% of the time are the market dynamics going to actually push the market upward. Conversely, only 15% of the time are the market dynamics going to push the market downwards. So that's where you end up looking at the market as a range. The market is always as a range, no matter how far back you go. Because if you go back far enough, you will always find the range. Let's go up to the monthly time frame and demonstrate that. Let's look at the entirety of the market. Okay, here we are, the whole market. The yellow region being the area I have been watching with my own trading. But the white region, this is the entire market range, the entire boundary. Price has been in this area throughout the entire 20-year history of Euro-Canadian. But as you look at the market, you can see realistically there have been other areas that were held beforehand that correlated or coalesced with previous levels. For example, the areas that I am watching on the chart, where the yellow lines are, we can see that the market has been in this area for a very long time. And even in this area, there are coalesced regions where the market has remained consistently over the course of several months or even a year or more. So overall, as you look at the market and you look for the range, if you can't find a range right away, go to a different time frame or go further back in time, and you will always find the range to work with. Remember that you are dealing with probability and statistics, and you want to do your best to put that probability and those statistics on your side. That is important, because the more information you have, the better your trades will be. That doesn't mean you're always going to win every trade, but it does mean you increase the probability of your profitability. So with that being said, let me know what you think. How do you trade this kind of a market? How do you see this kind of a market? Share your thoughts. Share your experience. How does lazy trading work in your circumstances? Do you find it easy to use, or do you find it difficult and chaotic? Let me know. If you have any questions, please ask them in the comments. Please let me know what your thoughts are. Thank you for watching, and until next time.